Hey there! You're probably wondering why the housing market hasn't crashed yet. Well, you're not alone. We all want to know why this is still going strong. If you're new to this channel, we publish weekly videos to help you learn life-changing habits and financial tips. Be sure to click the like, subscribe button to be notified each time a new video is released. Banks don't want you to know that they're in a race against time to get as many people into homes before the market goes south. The truth is, banks are doing everything they can to keep it afloat. But for how much longer? Here's what we know so far. All bubbles eventually pop, and when it happens to US housing prices, there will be no one to help out homeowners. The only thing propping up home prices are low interest rates and banks that haven't written down mortgage loans. Which hasn't happened because bank reserves are at a record high thanks to low interest rates. When interest rates go up, watch out! A financial meltdown like no other will happen. Wall Street was hoping its high net interest margin would last forever. It won't. Banks' net interest margins have been steadily declining for years as banks sell off assets and hold more reserves in order to meet government regulations. Banks don't want you to know about their coming collapse, but they're not doing anything about it either. They're just waiting for the bubble to burst so that they could buy back assets at bargain basement prices from desperate investors who need cash fast. By then though, it'll be too late. Banks will have blown through their reserves and borrowed against them to keep buying other banks' worthless assets. And if banks do fail, they won't get bailed out by a government like in 2008. Today's reserves are gone tomorrow if banks start writing down mortgages or selling off assets to raise capital. And banks aren't writing down mortgages or selling off assets anytime soon. Why would they? Low interest rates give them a huge net interest margin that's way higher than it used to be before the financial crisis. Why wouldn't they take advantage of these conditions? You see, when a bank makes a loan, they have to keep it at least 5% of that loan on their books until it's paid off. That's called reserves. And right now, with interest rates being so low and home values being so high, banks can profit from making loans even if they don't sell those loans off immediately. They're still making money by keeping them on their books, and this is called net interest margin. The housing market is fairly predictable and the Federal Reserve can simply regulate it. Everyone needs a roof over their head, thus there is always a need for houses. Even if you have a shelter, a house is one of the finest assets to invest in since it generates income. Home demand will always exist, but it will fluctuate depending on the price. Because the economy was at its pinnacle from 2017 to 2020, housing prices did not rise at all. If they were increasing previous to 2017, investors may only observe stagnation in the property market. Mortgage rates were at 4% to 5%, which hampered the demand for homes. But in 2020, the interest rates were reduced to virtually 0%, making mortgages much more accessible. Purchasing a home at 2 to 3% interest rate is one of the most important financial choices you will ever make. That is what spurred the demand and caused the prices to rise by more than 20%. The demand will diminish the instant those ultra-low rates disappear, as experts have predicted all along. But guess what? The Fed has not raised rates in the previous 2 years. They kept them at less than 1%. And of course, Federal Reserve Chairman Jerome Powell has stated that the central bank wants to raise interest rates this spring. But this is not certain because the Fed frequently does not do what they say until they do it, or occasionally misinterprets facts in order to avoid market panic. They continued repeating that inflation isn't a problem in 2020 and 2021, even though the Fed had the greatest data available and knew it was a problem. But to calm everyone worried, they kept saying that inflation is around 3%. At the end of the day, inflation above 3% is unsustainable. The major concern is whether the market would fall if interest rates are increased. The answer is most likely no. The housing supply has dropped considerably since the 2008 financial crisis. This graph clearly shows how many fewer residences have been constructed since then. And as a result, the supply of dwellings was already limited, preventing progressive increases in real estate prices. However, the epidemic just decimated whatever supply chain remained, so even if mortgage rates rise significantly, house prices will not fall since there aren't enough properties on the market to begin with. This supply network has been in the making since the conclusion of the World War II. For example, to create a single Timberland boot, supplies would be flown from 5 or 6 different nations to a facility in Thailand, where they would be constructed and then sold all over the world, including the United States. And as a result, a closed facility in one location might have an impact on the remainder of the supply chain. Companies are redesigning their whole supply chains to prepare for another pandemic, for example, by shifting facilities closer to where the final product is marketed. That will take some time as we learn how to live with this infection. About 91% of those house construction businesses polled by Zonda said they were having supply chain issues. Building a home takes longer due to a paucity of materials, and the delays and increased input costs are adding to rising home prices. This is the most dire scenario since at least World War II. And they aren't the only reasons. Corporations are purchasing homes to rent. Around 20% of properties are purchased by corporations, significantly reducing the number of homes on the market. However, inflation is by far the most serious concern. Inflation has a significant psychological effect. People are less inclined to sell today if they expect their house to cost more in the future, especially in the near future. What does that imply exactly? With fewer properties on the market, prices will continue to rise. I mean, why would you sell your home now if you could sell it for 10% more before the end of the year, for example? So anticipate property prices to remain volatile until inflation is solved or supply networks are restored. But why hasn't the Federal Reserve raised interest rates? The Federal Reserve's mission is to ensure that the economy grows as well as combat inflation, and the previous 2 years have proven to be far more unexpected than anyone had anticipated. At first look, it appeared that the problem would be fixed as soon as we developed a vaccine. However, the government struggled to vaccinate enough people, and new strains of virus continued to emerge that we are not protected by the present vaccine. Finally, by the time we worked out how to cope with the new variation or persuaded the rest of the population to get vaccination, those who had already had it had to get it again. It's an endless crisis. Most government officials are realizing that no matter how bad this virus is, there is no way to completely eradicate it. And even if we could, it will be so expensive that it isn't worth it. So we're learning to live with it. As a result, the Fed is keeping rates low until it is obvious how the economy will respond to the new constraints. If your housing investment is looking bleak, don't despair. The marketplace will continue to feel the effects of this economic recession for some time yet, meaning that it may be a while before prices recover. However, if you have done your homework and done your due diligence with regard to your housing investment, you can rest assured that there is no reason to panic or make rash decisions about your property. Rather, you must maintain a sense of faith in the market and continue to research potential opportunities. As Winston Churchill once said, never give in. Never, never, never. That concludes today's video. Don't forget to subscribe and leave this video a huge thumbs up. And as always guys, tell us what you think about this video in the comment section. We'd love to hear them. Thanks for watching, and we'll see you at the next one.